We're in a $100 silver window, not because it's printed everywhere on every screen right this second, because the market is stressed, and one catalyst can force a reprice. Two things define this regime. First, Shanghai is clearing higher. Kitco described a sustained Shanghai silver benchmark premium of roughly $10 above Western spot, and they were explicit about why it can persist. Capital controls and shipping logistics friction can stop textbook arbitrage from crushing it. Second, Iran war risk just pushed the tape into an event market. As of Feb 28, 2026, AP's live coverage describes U.S. and Israeli strikes on Iran and Iran retaliating with missiles and drones toward Israel and U.S. bases in the region. That combo is why I'm calling it a window. One word only in the comments. Window if you think tell number 1 and tell number 2 align and the path toward $100 opens. Fake out if you think acceptance fails and we flush first. Window or fake out. Quick guardrails. Tight and done. Different feeds and contract months print differently in event regimes. Watch behavior, not the exact tick. I'm not claiming motive. Timing doesn't prove intent. I'm explaining mechanics, educational only, not advice. Now, whole video in one sentence, right now, so you know what to listen for. If war risk keeps markets in event mode and Shanghai keeps paying up, the one catalyst is the moment the market realizes normalization isn't coming, and COMEX has to adapt. Two tells decide everything, and I'm paying you early. Tell number 1. Does the Shanghai premium refuse to compress on Western sell-offs, or does it finally mean revert? Tell number 2. After the first pullback, do we get acceptance? 2 hourly body closes holding the decision zone, or does the move fail once liquidity normalizes? That's it. Now let's earn the $100 framing without turning into hype. A $100 window is not a prediction. It's a regime statement. It means the conditions exist where a round number level becomes reachable faster than people expect, because the market is already stressed, already volatile, and already showing dislocation signals. In calm markets, $100 is a long discussion. In stressed markets, $100 is a short walk, if the structure lines up. And right now, structure is lining up in a way that forces one question. Why is a major clearing hub paying up, while the West still wants to anchor to a calm screen? Quote. Kitco's reporting framed it as physical demand challenging Western pricing, and highlighted the Shanghai premium as the most apparent divergence, roughly $10 above Western spot, with real-world frictions preventing easy arbitrage. That alone doesn't guarantee anything tomorrow, but it changes the kind of market you're in, because when a premium persists, it stops being a curiosity, it becomes pressure. Now I'm going to compress the arbitrage section into one punch so we don't lose retention. Arbitrage isn't a spell, it's permissions, capital, logistics, and settlement. When those bind, spreads persist. That's the adult lane. No villains needed. Now add war risk. Event regimes don't trade like spreadsheets. They trade like stress tests. And today's tape is being traded as a stress test. Strikes, retaliation risk, unknown next steps. That changes behavior. It changes risk management. It changes the willingness to provide liquidity. It changes how fast capital rotates. And that's why the $100 window matters now, not someday. Because silver is the devil's metal in event regimes. Gold is deep. Gold absorbs size. Silver is thinner. Silver is high beta. Silver expresses stress more violently. So if gold catches bids in a crisis, silver doesn't just catch bids. It whips in both directions until the structure settles. Now let's anchor price without inviting skepticism. Use one clean reference and move on. Kitco's spot silver chart is showing the market trading in the low to mid-90s range in this late February window. We're not in $20 silver. We're in a high-vol stress band where round numbers matter because positioning and hedging matter. Now you titled this one catalyst. Here's the clean definition. I will say it twice, not 5 times. The catalyst is the market realizing the gap won't normalize via paper selling. And the way you spot that is simple. You get a Western sell-off, and Shanghai refuses to loosen. That's it. That's your catalyst forming. Because paper can drop in a day, but physical clearing doesn't lie for weeks. Now, if you've ever watched a commodity reprice, you already know the pattern. It doesn't reprice because everyone agrees. It reprices because it becomes expensive to keep the old price functional. The system has to clear supply and demand across regions. If a major hub persistently clears higher, the system eventually adapts. That adaptation can look like COMEX catching up, bottom-up compression, Shanghai loosening, top-down compression, or rule behavior changes that reduce stress. You don't need to guess which one. You watch the tells. Now I'm going to make tell number 1 visual, so even casual viewers get it. If Western price dumps and Shanghai won't budge, that's not normal. If Western price dumps and the premium compresses quickly, that's normalizing. That's the difference. And if you want to track the premium consistently, instead of arguing over screenshots, use one stable tracker. Metal Charts has a dedicated Shanghai premium page you can reference daily. Consistency beats perfection. Now, tell number 2 is your survival tool, acceptance after the retest. Because in an event regime, the first candle is the headline. The retest is the truth. Here's the method. Feed agnostic, no guessing ticks. Go to the 1-hour chart. Find the impulse candle that kicked off the move, the candle where range expanded and price broke out a chop. Mark 2 lines. Line A, the breakout candle body close. Line B, the midpoint of the impulse move, high to low. That band between A and B is your decision zone. Rule, 2 hourly body closes holding that band after the pullback turns acceptance. 1 candle is noise, 2 closes is acceptance. Lose the band and fail to reclaim, that's rejection, and fake out odds rise. That's tell number 2. Now I want to add one line that saves people money. A $100 window can still flush first. Event regimes love to clear leverage. That's the trap. Here's the trap that wipes people out. They see premium and war risk and assume up only. Then they lever up. Then the market does what it always does in stress. It punishes leverage. So we don't trade excitement. We trade the verdict. Now, the reason a round number like $100 matters is not mysticism. It's structure. At round numbers, option strikes cluster, stops cluster, dealer hedges cluster, retail attention clusters. Above a handle, stops aren't scattered. They're stacked. So if the market approaches $100 in a stress regime, the path will not be smooth. It will be a sequence of jumps and fights. That's why you need rules. Now, I want to connect this back to something concrete that speaks to the pressure theme. Kitco also reported that COMEX registered silver dropped below 100 million ounces to 138,005 ounces after a large adjustment in February, framing it as part of a tightening story. I'm not going to turn this into registered means default. Registered is a buffer. Buffers don't dictate daily price. Buffers dictate sensitivity. When sensitivity is high and war risk is high, moves get violent. Now, one scale punch, one only, so you understand why buffers and paper claims are different worlds. CME's silver futures contract size is 5,000 troy ounces per the contract specs. That means paper exposure scales extremely fast. Again, not a conspiracy statement, a structure statement. And structure under event headlines becomes volatility. Now let's talk about COMEX catches up without making it a slogan. If COMEX is going to catch up toward Shanghai, you'll see it in 3 behaviors. 1, Western sell-offs stop following through, dips get bought. 2, the retest holds. 2 hourly body closes hold the decision zone. 3, the premium begins to compress in the bottom-up way. Shanghai stays firm while COMEX rises toward it. That's what catch-up looks like, not an announcement, a forced adaptation. Now, what does the opposite look like? What does fake-out look like? Fake-out looks like this. War headlines spark a spike. Premium creates narrative fuel. Late leverage piles in. Then the market clears leverage. Acceptance fails. You lose the decision zone. Reclaims fail. And the premium compresses because Shanghai loosens or because the whole complex is liquidating. That's the difference. So you don't need to guess whether we go to 100. You need to see which behavior is printing. Now let's bring the war risk back in because this is what turns a normal premium story into an explosive window. In a calm week, a premium can persist and nobody cares. In a war risk week, premiums become pressure gauges because war regimes increase the value of reliable settlement, immediate availability, and hedges that don't depend on a fragile counterparty chain. So if the East already clears higher, war fear can amplify the frictions. And that's why this window matters. Now, the middle section is where creators lose viewers, so I'm going to keep dopamine hits frequent. Here's the one thing people miss. The premium doesn't matter because it's China versus the West. It matters because it tells you whether the market is relieving stress the normal way. Normal way, price drops, physical loosens, premium compresses. Stressed way, price drops, physical doesn't loosen, premium stays stubborn. That's it. Here's the second thing people miss. In event regimes, the first move is often wrong. Not wrong directionally, wrong structurally. It's the move that clears positions. The real move starts after the retest. That's why the retest is the verdict. Now let's do the scenarios. Bearish first, bullish second, because we respect risk. Scenario 1, fake out first. In this scenario, the war regime is hot, but the market still needs to clear leverage, so the first rally attempt fails. The pullback breaks the decision zone. You don't get 2 hourly body closes holding it. That means acceptance didn't happen. In this scenario, the premium may still exist, but the system buys time through volatility. And buying time looks like wide spreads, stop sweeps, ugly candles, and this doesn't make sense behavior. This is where impatient traders get wrecked because they treat the first candle like the verdict. Scenario 2. Window opens. In this scenario, war risk keeps hedging demand alive, and the premium refuses to mean revert. COMEX tries to flush and fails. The pullback is bought. You get 2 hourly body closes holding the decision zone. That's acceptance. And then the premium compresses the bottom up way. Shanghai stays firm, COMEX rises. That's catch-up. And once the market is in acceptance and catch-up mode, round number handles like $100 become reachable in a way that surprises people because the structure is stacked. But again, this does not mean straight line. It means the window is open. Now, here's the reality check that keeps you honest. This is probabilities, not prophecy. The tape tells you which scenario is active. And here's the clean decision tree. Dopamine clarity, with no hype. If war headlines stay hot, plus acceptance holds, plus premium stays stubborn on sell-offs, window. If acceptance fails, plus premium loosens, plus spreads normalize quickly, fake out. That's it. Now, I want to give you the 24 to 48 hour watch list. Only 3 items, no clutter. 1, headline trajectory. Does the market price escalation or containment? AP live updates are documenting strikes and retaliation risk and ongoing uncertainty. 2, retest verdict. 2 hourly body closes holding the decision zone after the pullback. 3, premium behavior. Does it stay stubborn during Western sell-offs? And if it compresses, does it compress because COMEX rises or because Shanghai falls? If those 3 align, your read is clear. If they conflict, you go smaller or you wait. Now, risk warning, because this is where people blow up. If you're trading this with leverage, you are in a meat grinder. Event regimes create slippage, stop runs, and air pockets. A correct thesis with bad timing can still bankrupt you. Long-term stackers. Your edge is time and discipline. Short-term traders. Your edge is structure and risk management. Know which camp you're in. Now, I'm going to close this with a replayable ending that people can repeat back to you in the comments, and that's how you build community without begging. Premium, war, verdict. Premium. Kitco described a sustained Shanghai benchmark premium around $10 above Western spot and explained why frictions can keep it open. War. As of Feb 28, 2026, AP's live coverage describes a major escalation with strikes and retaliation risk being traded as event risk. Verdict. Don't trade the first candle. Trade the retest. 2 hourly body closes holding the decision zone after the pullback. Watch Sears acceptance and continuation odds. Failure to reclaim, check, fake out, flush odds. Window or fake out. Pick one. Then come back after the retest and tell me which one printed. Logic over hype, always.